Good day, my name is Adrian Meager, and today I'm going to take you through a global market update. A recap of the first 2 months of 2026 indicates the world economy is clearly showing signs of being in a late cycle phase. Growth is still positive but slowing. While inflation is easing unevenly, let's break down what happened in February and what this means for investors. So let's start with a global macro snapshot. Global manufacturing picked up slightly with PMIs rising above 0.5 percentage point. Goods inflation continued to cool, but services and wages, especially in the US, kept overall inflation at 2.4% in February for the US. Major central banks, example the Fed, ECB, Bank of England, held rates steady and stayed firmly data driven. Meanwhile, if we look at the US, large fiscal deficits and heavy treasury insurances kept long-term yields elevated. If we look now regionally and we look at their economic performances, the picture is as follows. For the US, growth held up thanks to strong consumption and AI-driven productivity, but earnings remain concentrated in the mega cap tech. Moving now to Europe and the UK, inflation fell to 1.7%, lifting real income and improving sentiment. Japan continued to outperform with strong reforms and wage growth. Emerging markets, if we look at Asia, excluding Japan and Brazil, remained firm, while China continued to face property sector pressure. Looking at global equities, rotation and divergence, stocks told a story of rotation. And looking at the US, the S&P dipped slightly as investors rotated out of high valuation tech. Small cap, however, jumped almost 4%, benefiting from broader domestic momentum. Europe and the UK had a strong month. Europe was up over 5.6% and the FTSE 100 up over 7%, with value sectors back in favour. Japan, once again a global leader, rising over 10%. Emerging markets up 5.5%, though China remained a drag. If we look at South African equity performance, the FTSE All-Share gained about 7%. This was led by resources, up strongly 13%, followed by financials, and industrials were flat. Standout performers for the month include Pan-African, Resources, AngloGold and Sasol, while SPAR and Pick n Pay struggled. Fixed income, attractive yields with more clarity. Global bonds benefited from stabilizing inflation and the risk-off sentiment. In the US, geopolitical tensions supported treasuries, bringing the 10-year yield to just under 4% at the end of February. Investment-grade credit maintained well-supported, while high-yield spreads widened slightly. Looking at South African fixed income, SA bonds performed well, supported by inflation, which had eased. It's now at 3.5%, and improved fiscal messaging. The All Bond Index delivered a 1.74% return, and the 10-year yield stabilized in the high 8.5% range. Portfolio implications for investors. So what does this mean for you as an investor? We believe you should reduce concentration risk in the US mega cap tech, moving into quality, value and selected small caps. Enhance global diversification. Europe, UK, Asia, ex-Japan and South Africa are all looking attractive. Keep China underweight due to structural challenges. Maintain exposure to gold and real assets with geographic hedges. In South Africa, nominal bonds, especially the 5 to 10 year maturities, offer compelling real yields. So in closing, staying resilient in a late cycle world. Global markets are clearly late cycle, valuations are tighter, geopolitical risks remain high, and inflation hasn't fully settled. But resilience is still the defining theme. For South African investors, the backdrop is improving. Disinflation, better fiscal positioning, and supportive commodities all help our market. A well-positioned 2026 portfolio combines strong SA yields, global diversification, global equities, strategic alternatives, and enough liquidity to capture opportunities as they arrive. Thanks for watching. If you found this update helpful, don't forget to like and share. And until next time, goodbye.